Here is the example of how the perpetual, inventory system works. So you have barcode reader, optical scanner, right? So they record the sales and updates the inventory records. So when they update the inventory record, two entries are needed for each sale. First, record revenue and asset received, and then record cost of goods sold and reduction of inventory, right? So all accounting system record each purchase of inventory. So when inventory is purchased on account, what is the entry? Inventory to accounts payable, right? And when inventory is sold on credit, you can say that when there is a sales on credit, then we create customers, account receivable to revenue, and then we make another entry. So though the cost of those goods that is sold, and we have to less these inventory from inventory in hand. So you sell there's inventory, that inventory is now the ownership of a customer. So we have to less inventory in our hand. So the entry would be cost of goods sold to inventory. So when expense rises, it's always debit. When asset decrease, it's always credit. So when you make a sales, two entries are needed. First to record sales, and then to record the cost of goods sold against inventory. So how inventory is recorded here, if you post that journal entry, so this would be the entry here, right? So this exhibit 6.5, it shows that we have existing balance. If we purchase the inventory on credit, inventory is increased, right? When we sold the inventory, so inventory worth of 5, so this is the cost of that units that are sold, that's it. So no profit is involved here. We just less it down and we make this as expense. Cost of goods sold is expense. It will go to the income statement right after sales, and the ending balance of inventory, which is on our asset side, you less those inventory units that are sold, that would be written in balance sheet, because that inventory is still in our hand and it is not sold. And now recording transaction in perpetual inventory system, which is we are already talking about the perpetual system right now. So entries are the same in both systems, whether we are talking about periodic and whether we are talking about perpetual. Okay, let's not make that confusion in your mind that entries are different. There are two systems, but the accounting policies and laws, rules, they are the same. Okay, so the cost of inventory is the net amount of purchase determined as follows. So all things count as purchases. For example, the price, you purchase 600,000 worth of goods. If you purchase and you have to pay the freight, then that would be added in the cost of inventory, less the amount of return that are not suitable good for you, you return that goods, you less from your purchases. So any allowances, discount, something granted by the seller, right? So this is called net purchases. So this amount is basically the cost that the buyer has actually paid to acquire those inventory, and that is basically the cost of that inventory, right? If seller pays the freight charges, then that is not added in the purchase price of the inventory. Okay, so the journal entries for purchase return of 500 in merchandise is given as this entry, accounts payable to inventory. Simple, right? So in this, let me just repeat that. The journal entry to record purchase return of merchandises that cost 500. So did you notice one thing? What is that? When you purchase the good on account, what is the entry? Inventory to accounts payable. You purchase the inventory on account. Inventory is an asset, it is increased, debited. Accounts payable, increase, which is liability, increase, credit. But when you return the goods, so this is opposite of the entry. When you return the goods, you decrease the balance of the supplier. So the liability decrease, it is debited, that's why it is debited. And asset decrease, it's credited, that's why it is on the credit balance. Understand? Okay, now the journal entry to record purchases 1000 in merchandise is as follows. It's simple, inventory to accounts payable, that's it. Let's move further. So the journal entry to record payments of merchandises within 10 days when the discount terms are 210 net 30. What does it mean? It means that if you pay the money within 10 days, you receive 2% discount. So remember in our previous example, the purchase of like 1000. So how are we gonna calculate the discount? 2% discount is 1000 multiplied by here 2% 20, right? So how are we gonna make this entry? Entry is you decrease your balance because you have to pay 1000. So the 1000 is the amount of liability that you need to pay. So all the settlement of the supplier balance is settled with this term. So we decrease our liability with 1000, right? And we actually paid cash. Cash decrease mean credits. How much cash we pay? We pay cash 980. So this entry is not equal because here is 1000, here is 980. So 20% is the discount that we received, not we paid, right? This is discount received. If we allow the discount, that is our expense, so that will be debited. Like in that case of, recall our discussion regarding when we grant to our customer 210 net 30, then that become discount expenses. But this time we receive this kind of, we receive the discount. It means that is discount, you can just call it that, that's discount income, right? Or allowance, some kind of like rebate, you can treat like that. Or decrease in expenses, you can say that, right? So increase in expense always debit, decrease in expense always credit. So that's why you can apply this logic here as well.